Hello and welcome to my YouTube channel, the Corcoran Codex, where I look at all kinds of interesting ideas in the world of finance, banking, and so on. And what I am going to look at in this video relates to the global banking industry and the regulations and rules that cover that industry. These come from a body based in Basel, Switzerland, known as the Basel Committee. And in particular, I'm going to look at the way that the Basel rules treat credit risk within the banks. It is estimated that on average, about 70% of the financial risk to banks, based on what they hold on their balance sheet, is relating to credit risk. So we're going to look at the rules and we're going to look at the capital requirements that have been established in order to absorb losses that could arise from credit risk. The Basel Committee introduced the standardized approach for calculating capital charges for credit risk as part of Basel II, and that method, the standardized approach, has continued through until Basel 3.1, or some people call it Basel 4. So the standardized approach provides a lookup table for banks to apply risk weightings in accordance with the committee's estimation of credit risk for different exposures. So the approach, which I'm going to come on and show shortly, provides quite granular differentiation for sovereign and corporate credits. Higher risk categories of sovereign and corporate bonds, for example, could attract a risk weighting of 150%. So in other words, you take the face value of the exposure, you multiply by 150%, and then use that number to derive the capital charge or the capital requirement. Certain items on a bank's balance sheet which are not rated by credit rating agencies, such as residential mortgages, have a standard risk weighting of 35%, and retail loans, also not rated, have a uniform or standard risk weighting of 75%. So the following simplified formula is used to calculate the minimum regulatory capital for credit under the standardized approach. The capital required, the regulatory capital, is equal to the risk weight, as just mentioned, multiplied by the actual exposure, the face value of the exposure. And to simplify matters, it is a little more complex. We multiply that by 8%, and that will give us what the capital charge for a bank is with regard to those items on the balance sheet that have credit risk exposure. As you can see on the screen, I'm going to come on in a moment and show this within Excel. We can see here there are these types of exposure identified by the committee: sovereign bonds, banks, and there are two options. There's only a minor difference between these: retail, residential, primarily mortgages, of course, and corporate exposure. This would be primarily corporate bonds held by banks on their balance sheet. As you can see, then, what is applied is the investment grade. Now, this is based on the average from the three major credit rating agencies. So just to take a simple example here, if a sovereign bond, for example, is rated, say, AA+, then the risk weighting applied to the exposure is 0%, and therefore, of course, there is no capital charge. This is in line with the idea that sovereigns within those ratings categories are very, very unlikely to default. If we then move down, say, to corporate bonds, and we then say, look at corporate bonds which are rated by the agencies with an A rating, you take the face value of the exposure, the bond, multiply by 50%, and then also apply the 8% to determine the capital charge. We can see just briefly here with sub-investment grade exposures, such as in the world of corporate bonds. So this would be essentially what are called junk bonds. We have a B-rated corporate bond. We multiply that by 150% and then apply that 8%. And I will go through this in more detail in a moment when I turn to an examination of this lookup table within Excel. All right, so I have now switched to Excel with the workbook in question, which is entitled Standardized Approach for Credit Risk. And we can see some of the points that I've already made. We can see these are the exposures that I mentioned: sovereigns, banks, options 1 and 2. The differences explained in the box over here. We have retail, residential, and corporate. And just to remind you, for example, I did say, let's say we take a corporate exposure, a bond, which is sub-investment grade, maybe a B-rated bond, and the appropriate risk weighting is 150%. And let me explain the simple interactive approach that I've included in this workbook. So let us say, for example, that we currently have here a sovereign bond rated B. Let's maybe change this to a corporate bond, but we don't type in the word corporate, we simply type in the number 6, which of course is the same as there. That then, through the lookup functionality in Excel, says, okay, so we're talking about a corporate bond, and let's make this an A-rated corporate bond, let us say. And we can see that in that case, an A-rated corporate bond has a 50% weighting. So the logic puts the number 50% there. Let's say we have, let's change this to, I don't know, 500 million. So we now have 50% of 500 million, which is 250. And we then apply the 8% capital charge that I've discussed, and we get a capital charge of 20 million. And let's say maybe we come down here to the bottom, and in this case we want to change this. This is no longer a corporate bond. We make it a sovereign bond. And let us suppose now that this is a B-rated sovereign. So let me type in B. And as can be seen, the appropriate risk weighting for a B-rated sovereign is 100%, which has now appeared in that cell. We'll leave that at 400. So the risk-weighted capital, the risk weighting now is 400 million, and we apply the 8% to give us 32 million. And what we can see now is that this number here represents the full face value of all of these items. Then we apply the appropriate risk weightings in this column. That is the risk-weighted size, if you like, of the exposures. Then we use the 8% to calculate the total capital charge for that configuration. One final thing that I should mention is right over here on the right-hand side, we have this idea of an unrated exposure. And now this would not apply in the case of retail or residential, but it would apply for corporate, sovereign, and so on. And the idea here was that the Basel Committee said, well, in those territories around the world where maybe these securities will not be rated, we don't want to penalize, say, the developing economies by having too high a capital charge. So we're going to limit the risk weighting to 100% for each of these, 100% down here. Some people have said this is somewhat anomalous, but as I say, the Basel Committee made that decision in favor of, let's say, developing economies. So we've looked at the standardized approach for credit risk. Now let us do a comparison with the alternative approach, which is actually confined to only a subset of banks, those banks which the Basel Committee or the supervisors actually in each jurisdiction have given approval to use the internal ratings-based approach, or IRB. So under SA, each asset class or derivative is assigned a risk weighting by the Basel Committee. We have said that. These risk weightings are based on the external ratings provided by the credit rating agencies, the big three, and an average approach is taken. Under IRB, banks and investment firms with sophisticated risk management systems may be permitted by their supervisors to calculate the capital requirements based on internally produced risk parameters. There were changes to the IRB approach recommended by the Basel Committee in 2017 as part of the Basel 3.1. Some people have even referred to it as Basel 4. However, there has not been full global implementation of all the changes, especially those relating to credit risk and to the IRB situation. I'll come on to that in a moment. The IRB approach offers two credit risk evaluation methodologies. One is known as the Foundation IRB approach, or FIRB, and there is a more advanced approach known as AIRB. Under both approaches, banks provide their regulators, supervisors, with an internal estimate of the PD for their various exposures. FIRB banks have all the other components that you'll see in a moment set by their regulators or supervisors. Advanced IRB banks calculate all of their risk parameters for this model, and I shall go in a moment and show how this IRB model actually works. In providing estimates of PD and or LGD, EAD, and M, which is a maturity term, an IRB bank can rely on long-run data derived from its own experience or from external sources, provided that the bank can demonstrate the relevance of such data to its supervisor. So I mentioned the Basel 3.1 initiative, and let me quote from this document published by the Basel Committee, or the BIS, and you can see the date here in 2017. So let me read out. As noted above, the financial crisis of 2008 highlighted a number of shortcomings related to the use of internally modeled approaches for regulatory capital, including the IRB approach. These shortcomings include the excessive complexity of the IRB approaches, the lack of comparability in banks' internally modeled IRB requirements, and the lack of robustness in modeling certain asset classes. So the committee is now recommending that to address these shortcomings, the committee has made the following revisions to the IRB approaches. It has removed the option to use the advanced IRB approach for certain asset classes. It has adopted input floors for metrics such as PD, as we shall see, in order to ensure a minimum level of conservatism in model parameters for asset classes where IRB approaches remain available. And 3, has provided greater specification of parameter estimation practices to reduce RWA variability. So we can see here, for example, large and mid-sized corporates with consolidated revenues of more than 500 million euros. Under the Basel II rules, AIRB was available, but no longer. And as we can see down here for specialized lending, AIRB is still available. But as I've indicated already, the adoption of Basel 3.1 in its entirety has not yet taken place. For example, the European Central Bank, in terms of regulating European banks, has postponed the full implementation of 3.1 or Basel 4 to sometime in 2027, and based on recent experience, that date could even get pushed back further. So let's look at the IRB approach. This rather nasty looking formula here, which comes from the Basel document, explains how the IRB approach or model works. There are in fact 3 versions of the model. The one that I'm going to talk about is the more complex one, which is the one that's used, say, for sovereign exposures or corporate bond exposures. They do have a slightly simpler model for retail and another one for residential mortgages. So we can see here K is the capital charge. That's what we're looking to calculate. And we can see reference to all kinds of metrics here. LGD, which is the loss given default. We can see the PD, which is the probability of default. M is a maturity term having to do with the, say, maturity of the exposure, either a bond or a loan, let us say. And we can see references to N, which is the normal distribution, the cumulative distribution for a standard normal variable. And we can see G, which is the inverse cumulative distribution for a standard normal variable. So there, in fact, is the equation. It is rather complex. And what I've done is take that formula and embed it into an Excel workbook. And I've actually given each of the three models. The one, as I say, this is the more complex. That's what we just saw on the last slide. We have these three key terms, the PD, LGD, which is loss given default, the exposure at default, and we have M, which is the maturity term. And what I've done is break this formula up. It's a rather complex calculation. I've broken it up into a number of components, and I've gone on and, for example, calculated the capital charge based upon whatever is placed in these inputs over here. All right, so I've now switched back to Excel, and I want to explain how this IRB model works. The first thing I shall mention is to repeat myself that there are in fact three models, and the one that we are going to go through is the one that is used for sovereign and corporate exposures. There is another model which is quite a bit simpler for retail exposures, and yet another model for residential mortgages. So as can be seen here, this is the formula, the equation that I have shown previously. Remember, this is the capital charge, and I went through and explained what each of these various metrics are: LGD, PD, and N, which is a reference to the normal distribution. M is a maturity term. There's another part of this formula which relates to correlation factors, which is actually explained here. So what I then did was to break this formula or equation up into several components or parts, and then I used various expressions including calls to Excel functions, the exp function, etc. And we can see further logic in the cell which relates to all of these components of this formula. So let me then demonstrate the way that this formula outputs the capital charge, the K. So we need to plug in the variables here. You remember in the case of the foundation IRB, we only really plug that one in. The others are set by the supervisor. But I'm going to consider the AIRB approach, where all four inputs to this model can be plugged in by a bank. So let's start maybe with a PD of 25 basis points. We'll use an LGD of 60%, which is fairly standard. Let's say we have an exposure at default of $100 million, and we're going to use a maturity term of 2.5 years, which is in fact the default value. So given those inputs and working all the various calculations down here, we can see that the total capital charge is $5.7 million. So a little more than 5% of that number there. Now, to demonstrate the sensitivity of that number to these different inputs, let's maybe see what happens if we reduce the PD to 0.1% and 10 basis points. And we see now that the capital charge goes to 3.4 million. On the other hand, if we increase this quite substantially, let's say we go to 1%, as can be seen, the capital charge now has scaled all the way up to $11 million. And for example, just to see what the sensitivity to changing the M term, the maturity term, let us say we use a 5-year term. And as can be seen, the new total capital charge is now $14.6 million. So there is actually another way of calculating this, which I have explained elsewhere by using logic from John Hull. And you can see that using John Hull's approach leads to exactly the same capital charge as the method that I have used, which is the full implementation of this formula over here. So I hope very much that you enjoyed that video and found it interesting and useful. If you find this type of material to be of value to you, where I analyze critical ideas and episodes in the world of global finance, could I strongly suggest that you decide to subscribe to this channel. Thanks very much for watching.